Hi to all. In this very short video, we will cover the calculation of the capital asset, the required rate of return predicted by the capital asset pricing model. Once we have, once we know the beta of a stock and we know the expected return of the market and we know the treasury rate as well. So once we have these three values, this becomes quite straightforward. The formula of the expected return R I, let's call it RI or let's call it expected return, right? According to CAPM will be equal to the risk-free rate and then plus the beta of the stock multiplied by then the expected return of the market minus the risk-free rate, and that's it. Let's keep in mind that the expected return of the market minus the risk-free rate, which is this is called market risk premium. And in other words, that is exactly how much units of return, how much percentage return investors require. So they invest in the market portfolio. So they invest in stocks basically instead of investing in riskless assets, instead of investing in riskless treasuries. Okay, so once we know this, the first thing when you have this problem is just let's type all of the values we have. We have the beta of Coca-Cola, which is 1.5 in this case. These are not real values. We have the expected return of the market, which is 10%, and we have the risk-free rate, which is 2%. So now let's just use the formula, and it will be risk-free rate plus beta times, and don't forget to open a parenthesis here, the expected return of the market minus the risk-free rate. So in this case, the expected return of the return that investors are going to require according to the capital asset pricing model for Coca-Cola is 14%. Okay, and now we can calculate this once we have once we already know the beta, the expected return of the market, and the risk-free rate. One slight variation, let's assume instead you are given beta 1.5, risk-free 2%, and market risk premium 8%. So this would be in essence the same, right? Market risk premium. So in this case, we would calculate the expected return according to the capital asset pricing model by adding up the risk-free rate plus the beta times market risk premium. And we already know that expected return of the market minus the risk-free rate, that is exactly the same as the market risk premium. So we just need to do this and we still have the same 14%. It's exactly the same problem, but it can be presented in either of these two ways. I hope this is helpful. Thank you so much for your attention.